It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to Your Personal Bank Show, and I'll tell you what, today we're going to talk about fixed income and interest rates. I know we've been talking a lot about different things. We talked about different safe money options. We've also talked about growth. We've talked about the economy and all kinds of different things. And, of course, the general focus of the show is the Your Personal Bank concept, which, again, for those of you who haven't heard, is really a two-step process. It's very simple. We set up a high cash value policy designed to maximize cash growth on a tax-deferred basis or tax-free basis. And it's not the type of insurance most people are familiar with. In fact, I'll get to that point in a sec. The second step, of course, again, it's a high cash value policy designed to grow cash. These are the kind of policies that a lot of like wealthy families, banks, corporation, finance boards, things like that tend to purchase. Been around a long time, nothing new, and it's just not generally commonly known with the general public. I'll put it that way. And then the second step is we set up a bank line of credit. The cash in the policy is the collateral for the loan, much like a HELOC or a home equity line of credit would be for a property. Many people are familiar with that. There's no interest charges unless you use the funds. There's no fees, no cost to set up the line of credit. And here's the key. We have strong dividend-paying companies that are paying 6% or more today and have paid that consistently for the last 25 years plus. And many of these companies have paid these interest rates literally. I mean, they've paid dividends and never missed since, over 100 years, some as far back as prior to the Civil War. So we're talking about long-term, strong dividend-paying companies. This is what they do, and they got the cash reserves and the financials and the ratings and everything else to continue to do that, pay strong dividends. And the line of credit, of course, the rates are as low as 3%. So I ask this question to folks all the time. It's really quite simple. If you're getting credited, if your money's growing at 6, you leave it there. You're going to continue to get credited at 6. Tax favored with guarantees, not a bad option. But if you access it and use it, and here's the thing, we all have access and use of money. If your money's growing at 6, you access it and you get charged 3, what's your money doing? Well, obviously the answer is very simple. It's very clear. Your money is continuing to grow. So you leave it where it is, you can make 6. That's on the fixed steady option I'm focusing on at the moment. We do have an index option. I'll talk about it in a sec. But if you keep it there in the steady option, it's getting credited 6. If you access and use the monies, you're still going to grow it. You earn 3. The difference. Now, why is that so important? I was just talking to a gentleman on my way into the station here, and I mentioned that same comment. He's a business owner, real estate investor, all those types of things. He got it immediately. As I pointed out, if your return on your investment is 10%, for example, and you flow it through the personal bank and pick up a 3% positive arbitrage, you just increased your top line profit by 30%. That's huge, folks, for just about any business. He agreed completely. Other thing I pointed out to him is, look, we spend money. We have expenses. It costs to live, right? There's monthly regular expenses going out for all of us. There's things that we like and need to buy, purchase items and things like that. What if we could capture, instead of spending the money on those items straight out, what if we flowed them through a personal bank policy, earned 6 on the money, accessed it, got charged 3, and then paid the bills, paid the expenses, or purchased the item, and picked up 3% interest on that money you spent. Add that up over time, over the next decade or 2 or 3 or longer. What kind of difference in money are you talking about? I mean, what's a typical American family's yearly expenses look like? I don't know, 40, 50, 60, 70,000 or more? That's just basic everyday stuff, right? What if you captured 3%, let's say, on that money that you were spending? That's the type of thing your personal bank can do. Now, why I'm talking about interest rates and things like that quite a bit is, most of us have been paying any attention at all, understand that the Federal Reserve has dropped interest rates basically rock bottom, basically close to zero. And so all the interest rates out there that, that are directly or indirectly affected by the Fed rate, interest rates have dropped down to all-time lows. We're seeing all-time lows on mortgage rates, all types of interest rates on loans. Now, the other effect of that, of course, is folks that are looking for income, those that are retired, or those that are, wanting to create some type of income through their investments or their portfolio. With the low interest rate environment that we're currently in, and by the way, the Fed has come out and stated that they plan to keep this interest rate environment at least through the end of 2022. So we're literally looking at another 2.5 years, perhaps longer, of this extremely low interest rate environment. What does that do? Well, that takes a toll. That pushes interest rates down on fixed income investments. It pushes the returns down. So income-focused investors, people who are needing or wanting to live off of income, those nearing retirement or in retirement already, are going to have a bigger and bigger challenge in trying to find assets that'll generate the necessary income. And things with guarantees and such, interest rates, the income that's generated off of them is particularly low. So that's why I point out is it's not only this, that the thing is what the personal bank does. I mean, if you can get a 6% dividend rate today, I think any reasonable person would agree that's strong. By the way, some of the questions I get is, well, how are they positioned to continue that? Many of these companies are very well positioned. They have the cash reserves, they have the financials, the ratings, and everything else to continue to pay these strong dividend rates out for the foreseeable future. For example, one of the companies I work with, they announced their dividend rates 2 years forward. So, for example, they're paying over 6%, and they've already announced they're going to do that for the next 2 years. And they've done that for the last 25, like I said, and never missed a dividend payment since before the Civil War. They have the cash reserves to handle it and accomplish these kind of dividends or near these dividend rates for quite some time. These are companies that survived the Great Depression and did the same thing through that. So my point is, if you're looking for interest, income, dividends, that type of thing, this is something worth looking at. But it's over and above. It's not just a straight head-to-head comparison of, this one pays this rate versus that dividend-paying stocks or bonds or whatever else you may be looking at. Anything else that's a interest or dividend-paying type of asset. It's not just the rate of return that it's paying is that's important. Don't get me wrong, but there's another aspect with the personal bank concept that further enhances the amount of money you have to spend and live on. And that is, again, you have the situation where you're earning more than you're getting charged when you access the funds. See, with any other traditional investment, things that, again, that we're all familiar with, when you spend the money, when you take the income, right, those dollars you spend are gone forever, aren't they? You're not going to earn interest on those monies ever again. So what happens is if you have a pile of money, so to speak, you have a bucket that's throwing off interest or dividends, and you're taking the income from that, over time, typically that pot's going to dwindle. It's going to diminish or get smaller. Therefore, the amount of dividends or what it throws off decreases over time, particularly if you're eating into any of the principal. Well, here, with the personal bank concept, you can eat into the principal and still pick up 3%. That's a game changer. So when I tell people this all the time, again, on the Fixed Steady Eddie, in the next segment, we'll talk more about the index options to increase even your returns further. But if you're talking about the Steady Eddie, leave it where it is, make 6. Access it, spend the money, use it, still make 3. Stay tuned. We'll talk about that further.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. Today we're talking about interest rates, dividends, income, that type of thing. And like I said, the personal bank concept really shines in that arena if we're talking about the steady, consistent, like I said, 6% plus returns, 25-year history of doing that or longer, over 100-year history of never missing dividend payments, credits, whatever. And so it's long-term, steady, consistent, A-plus rated, plenty of cash reserves. These are long-term dividend payers. And then access the money through a bank line of credit where they only charge as low as 3%. And again, you're earning 6%, you're getting charged 3% on money you spent. What's happening? Your money's still growing. So not only is it you're getting that dividend, you're getting that interest, you're getting that growth or that consistent, steady income, but you're also still earning monies or growth on the funds after you spend them because you're able to pick up the positive arbitrage with the dividend-paying policy combination with the bank line of credit. Now, some other thing, let's talk about growth a minute, and then we'll go back to more of the steady stuff. Some people say, well, I want more than 6. Well, okay, that's fine. We have an index option. An index option is really quite simple. It's based on the S&P 500. Your growth is going to be it's a floor and a cap. You're going to make somewhere between the floor is 1% and the cap is 14%. So basically, it's a 1-year point-to-point S&P 500 index. 100%, whatever the index does, that's what you get. So if it grows up 10, you get 10. If it goes up 15, you get 14. Okay. If it goes down, you still get 1. So the point is simple. If you want if you want growth based on the index, so you want higher upside potential, but you don't want the downside risk. I worked with a client yesterday on this. Very successful business owner, he's actually also a financial advisor, happens to be, and works with a lot of the Chinese market, Chinese-American gentleman. But he doesn't deal in this arena because what a lot of people don't realize is there are specialties in the financial world. And just like in the medical practice, you have MDs and then you have specialists. Okay, so when it comes to growing cash and dealing, on a tax-favored basis and insurance contracts and banking tools and stuff like that, I'm very much a specialist. I'll get into that a little further, but I want to finish the thought on the index strategy here, and it's this. I don't know what you're going to make year to year. It's all dependent on the index, obviously, S&P 500. We understand that. But it'll be somewhere between 1% and 14%. So that creates a nice window, you see, of what you're going to get. You got you eliminate that downside. When you take the downsides off the table, that really gains a little bit more consistency of returns. And by the way, that particular strategy has averaged 8.52% over the last 25 years. I can show you the information. Contact us at yourpersonalbank.com. It's company approved, compliance approved. It's third-party approved stuff. Okay? So, again, yourpersonalbank.com. Contact me. I'd be happy to send that information to you and discuss further. But despite what folks may or may not hear, this is what these things have actually done. Okay? Which brings me, I guess, to that point I was starting to discuss with this client of mine. Like I said, he's a financial person. He owns a company. He also deals a lot in financial investments with the Chinese community. He's a Chinese-American himself. And I've been working with him for about 4 years, and we had a really good discussion, in fact, just yesterday. And he says, Ferenc, I'm familiar with the financial world. As you know, I'm in it. I work with clients all the time. I recognized I had some death benefit needs for myself, my business, my family. And so I just thought of insurance as a death benefit tool until I met you. And I said, I understand. He goes, and I've talked to many different financial advisors. I've talked to many different insurance agents. And when it comes to insurance, all they really talk about is primarily their focus is the death benefit. And I'm going to say this. There's nothing wrong with that. Okay. It's just, my point is insurance can do a lot more than just that. And he even said, look, I just wasn't aware of what the potential, the cash growth, what could be done. And he's done very well. We've done very well for him the last 4 years. His accounts are up significantly. And even in the downturns of stuff, when he wasn't concerned because he had the downside floors. And we were able to determine he had some very specific income parameters he was wanting to accomplish for retirement. So we were able to reverse engineer based on these income needs. This is how much you need to contribute per month for X amount of years. And it was actually 5 years shorter than he originally thought it would be. He was very pleased. And even said further, we talked some more further after we kind of put this solution together for him. And he says, I just wish more people understood how well this can work for them. I just, like I said, it's like a chorus out there of talking about, the markets. And he says, it's like you're the lone voice almost out there. I'm not the only one, but there's not a lot of folks out there pointing out why there's another option out there. And this other option can create a lot of solutions for people that a lot of people don't think about. I mean, right off the bat, it's nothing else as a diversification tool. Why not diversify into something that's totally unrelated, a non-correlated asset? I've talked about that many times previously. But why not look at something where you can have that diversification, true diversification? Irregardless of what the economy and the markets or various things do, we can get the steady options, we can get the index options, like I said. But again, really what's more important is how much money are you going to have? Are you going to run out of money in retirement or not? And that's a very valid question for most people. Studies show 80-85% of retirees, that's their number one concern. Am I going to run out of money in retirement? And isn't at least one of the big reasons why people do retirement planning, why people invest and put money away for the future, isn't one of the primary reasons so that you have money for retirement? I think that's pretty valid. So having something that has some consistency or with some guarantees, with some tax benefits, and then on top of that, positive arbitrage. Positive arbitrage is a game changer. Because again, in any other traditional investment financial tool you can look at, once you access the funds and spend the money, the returns on those funds goes to zero because you don't have the money anymore. Here, you can cause your money to grow further, last longer, continue to grow for you even after those dollars are spent using the positive arbitrage. Like I said, if it's not clear or you have some questions, contact us. Contact us at yourpersonalbank.com. I'd be happy to talk to you and share with you. It doesn't take me long to share with you how this works. We can talk on the phone. I can do a quick go-to-meeting, whatever. And it becomes extremely clear to folks, wow, this makes a lot of sense. I definitely want to allocate some funds this direction because I do want to have the option of funds growing. I like the safety, the guarantee factors are nice. The tax benefits are nice. But the ability to access money and still earn interest on it after you've spent it, folks, we all spend money. Why not earn some interest on some of those dollars that are spent? That's the point I make to just about everyone I talk to. And that makes a difference in your financial future. Okay? It just does. It makes as much or more of a difference oftentimes than what the person's rate of return on their investments are and things like that, or what their tax bracket is. Those are all important factors. I understand. But what about earning interest on money you've spent? I'm quite confident that for most people that are listening to me, that's something they've never even thought about, considered, or been introduced to. Stay tuned in the next segment. We'll talk about it further and how it'll change your financial future.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. And hey, I failed to mention one thing that I thought was kind of interesting and fun. I've been in the industry for 22 years. I've had the blessing, privilege, whatever, to be recognized for a number of different things as a top producer, and won a global management award last year and things like that. And you get nominated for a lot of things, and some of them are, you know what I'm trying to say, they're hokey or whatever. But actually yesterday I was just nominated as a top 100 Visionary Award through Global Finance. I checked it out, and it's actually quite a large organization. I wasn't aware of. I'd kind of sort of heard about it, but I guess it's quite the organization, one of the largest financial groups in the world. It seems like, and to get nominated obviously is an honor. As a visionary in the financial world, that's kind of a neat thing. I'll keep you all posted. Apparently, if I am nominated, they want me to come to an event in Vegas in December. We'll see if that happens or not with COVID and all, but kind of a fun thing. It's fun every once in a while when you get a little bit of recognition for what you've been working hard on. I've been doing this for a number of years, and like I said, I was talking about before, really paving the way. I mean, what I am doing is visionary. I get told this all the time from folks both in the insurance arena, the financial investment world, and the banking world. They're like, how did you think of that? Or, and again, I think it just comes down to being an entrepreneur, having a lot of experience in those arenas, owning several different businesses, being in the financial arena. And, I've worked with thousands of clients in my 22-year history. Still do. Work with folks every day. And then being on a bank board. And you kind of put all those things together. And so I've got my hands in various different areas of the financial world, which is, as my wife always says, you're kind of a Renaissance man. And so it's not, what I've come to find out, it's not common. I'll put it that way. I mean, most people, nothing against that, they get focused in their area and they know their area and they have their comfort zone. I've always been a person that I enjoy new challenges. I learning new things. I get bored easily. How's that? I learn something, I master it, and then I kind of get restless because I'm like, okay, what's next? So by understanding these different tools and these different products and whatnot, and I realized, wait a minute, I'm not the only one that's doing this. Don't get me wrong, but it's just not a well-known concept. How's that? It's been used for decades and decades. Okay, one of the banks we work with they told me has 1.8 billion. I was thinking about the federal deficit there a minute. No, but 1.8 billion of these types of loans on their books. They've done over the last 20-something years. So this isn't something that is like, people are poking a stick at, see if it works or the kind of thing. No, this has been going on for decades. It's been working very effectively. It's just not common knowledge to the average individual. That's all. So it's not a big secret. Some people try to make it out to be like that. It's just if somebody you're talking to, an advisor, a financial person, a friend, or whoever it may be, is not familiar with the personal bank concept, for one, just because you don't know about it doesn't make it a bad thing. It's just they're not aware of it. Two, very few people, particularly in the financial arena, are going to be exposed to this kind of thing. Because, again, unless you're on a bank board or corporate finance board, or you're dealing with a family office or some of the really high finance arenas in the financial world, or you're dealing with one of the banks that specializes in this kind of lending, you're just not going to get exposed to it. Here's a perfect example. So we had our bank board meeting 2 days ago. And our bank president, who we've hired, and of course everything's on hold because of COVID, but this is a gentleman with 40 years experience in banking. He's been the bank president of 2 previous banks. He helped start a bank last year, one of 10 people in the United States to open a bank, a new bank, since the 08-09. One of 10. This is one of the top, and FDIC considers him, and they've stated that to us, one of the top bank presidents in the country. So we're very excited to have this guy as part of our team. We've hired him. But 2 days ago, I said, Don, are you familiar with the insurance banking concept? Are you familiar with bank lines of credit using the cash value of policies as collateral for the bank line? He kind of looked at me. He's, of course, go to meeting. But he goes, no, I haven't. He goes, but that sounds interesting. Tell me more. So as I explained to him, it works very similarly to a HELOC, a home equity line of credit, which, again, most people are familiar with. He's like, well, that just makes sense. He goes, we definitely want to look at incorporating that into our bank. We'll have to figure out some of the logistics and whatnot and how it works. I said, well, I'm familiar with a lot of that already from working with the other banks and being an insurance agency, an agent and owner and all that. He goes, well, that's great. You can help us put that program together. I said, exactly. So he immediately recognized that it was a great program and how it would work. And he immediately liked it. Just been 40 years in banking, never been introduced to the idea. And I mentioned that, and I said, I've identified 4 banks in the United States that do this. They specialize in this area of lending. It's a very specialized area of lending. He goes, yeah, I imagine it is. And I said, what's funny is in all 4 cases, it seems, there's somebody involved with that bank from the insurance world that brought that to our attention. He goes, yeah, that makes sense. Otherwise, again, these are banks. They're not stupid people. They do lending all the time. I mean, that's what banks do. But until they're introduced to the idea, they're not going to be aware of it. So it's no different for you if you're listening. If you haven't heard about the insurance banking concept or your personal bank, it's not that you're not a smart person. It's just you've not been exposed to it. You've not been introduced to it. And that holds true for most financial advisors. The vast majority have just not been exposed or introduced to this idea, or they may have heard of it, very cursory, but don't have much familiarity or understanding because, again, it's just not an area of expertise. It's not an area they focus on. It's not an area they deal with. That's all. That's what I do. So what I've done is I've become a part of a very specialized area of the financial world. And it's kind of, I have fun because I enjoy educating. I mean, gosh, why else would I be doing a radio show, right? I mean, that's probably the biggest motivation is for me, this is fun. I enjoy sharing ideas and educating people to things. And when I can bring something to the table that's new and different and makes a difference, well, there's my passion. You just figured out what it is. So I have fun with this, sharing this idea with people. Again, learning how to earn interest on your money, get paid dividends, solid, strong dividends, 6% plus. Like I said, 25-year history. I'll show you the charts. Contact us at yourpersonalbank.com. I'll show you what these companies are doing. I'm agnostic to which company you work with. By the way, I'm contracted with most of them anyway. It doesn't really matter to me who you go with. What I'll show you is the charts, who's been paying the best dividends, who's got the lowest fees. And we'll run the numbers and compare. We do it all the time. And then you'll know and you'll have confidence in knowing you have the best product out there that's paying the best dividends. Also, there's 3 things you need to understand about this. The dividends is just one part. What is it paying? The second part is, what are the fees or costs, right? So you want something with a strong dividend and obviously with low fees. But there's a third piece, and that's what's it cost when you access the money. Well, we're going to talk about that in the next segment because that's how you maximize income, interest, and keep more of your money and make sure that money doesn't run out in retirement.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, we're rounding third. We've been talking about interest rates, income, dividends, that type of thing. And, of course, with the low interest rate environment that we're dealing with, the Fed has put interest rates pretty much close to zero, has stated they're going to keep them there through the end of 2022 at least. So we're looking at a very low interest rate environment for the foreseeable future. What that does, of course, 2 things. When you're borrowing money, that's why you're noticing interest rates on mortgages and various things that you borrow money on is hitting record lows. But also that impacts when you're trying to live off the income or you're trying to live off dividends or interest or that type of stuff. That puts downside pressure on the returns of those types of investments, so those fixed income tools. Well, this is an area where Your Personal Bank shines. And it shines because we have companies that are long-term dividend payers. We have companies that are paying 6% plus, have so basically every year for the last 25 years. I'll show you the charts. I'll show you all the different companies. This was not put together by the insurance industry. This was put together by the financial the financial banking industry, because they're comparing these because they're doing loans, they're doing lines of credit against the cash of these policies. If you're earning 6 and your line of credit when you access the funds is 3, you keep the difference. What's your money doing? So you leave it there on the fixed steady Eddie, you're earning 6. If you're doing the index, it's 1 to 14 with an 8.5 historical average last 25 years. So if you're earning somewhere like 6 to 8.5, depending on what you're dealing with, and you access the funds through the bank line of credit and they charge you 3%, what's your money doing? Well, it's growing. It's still growing. You keep the difference. That's the key to your personal bank concept, and that's the key to make sure you don't run out of money in retirement. One of the big keys is, how much money will I have? How long will it last? Because most people understand that when you start accessing funds from accounts, in retirement particularly for income, eventually if you're tapping into any principal, the principal dwindles. The amount you have reduces. Therefore, your returns reduce because there's less dollars there. Well, here you actually can pick up the difference, some positive arbitrage on some of the dollars that you spend. So whether you're still working and you're earning and you're growing, or you're in or near retirement and you're accessing the funds now, being able to pick up positive arbitrage on money you spend makes a huge difference in your financial picture, particularly if you look at it over a period of time. I've been sharing this. See, the thing that a lot of people miss, and this makes the difference. This is one of the key financial literacy secrets, and it's not a secret, it's a financial literacy key that people miss, and why their financial position, their situation isn't as strong as maybe they want it to be, is because for the most part, most people overly focus on the growth side, the rate of return, sometimes to the exclusion of just about everything else. What they're missing is rate of return is important. Absolutely, I completely agree. But it isn't the only thing that's important, and oftentimes it's not even the most important thing. What am I trying to say? What I'm trying to say is how much money you're going to have in your pocket when you access the funds and need to use them. Whether you need to use them for a short-term need, whether it be an economic situation, a loss of income, a medical situation, or anything else, or you're needing it for longer-term things like supplementing retirement, or you want money for a business opportunity or an investment. How much money you're actually going to have in your pocket you can actually use and allocate? Well, rate of return is one of the factors. What's the tax consequence? After tax, how much is it of it's going to be yours? Okay? And when you do allocate or spend those dollars, are they gone forever from your ability to earn? In most cases, the answer is yes. With a personal bank, the answer is no. You can still pick up interest, positive arbitrage, the difference of what you're earning minus what you're getting charged. There's a gap. It's 2 to 3% right now, depending on the amount of funds that you can still pick up on dollars you spend. Here's a way to look at it. Another way to look at it. How much money do you spend each year? You know, the average family in the United States spends somewhere between $50,000 to $70,000 per year just on basic necessities. We're talking food, clothing, housing, that kind of stuff. I'm not talking about the extras. What if you were able to pick up 2 or 3% interest on $50,000 a year that you spent, or $100,000 a year you spent, or whatever that number is? It doesn't matter. Well, you'd pick up an extra few $1,000s, wouldn't you? What if you're able to do that every year the rest of your life? You throw in compound interest on top of that. Now, the amount of dollars that you're keeping control of or earning on the dollars you spent, not just the dollars you still have and growing, but dollars you also on dollars you spent. The amount of money you'll have in your pocket, the amount of money you'll have to spend can increase dramatically. And that is understanding taking control of your finances, and taking control of your financial situation, and changing your financial situation for the better, often in dramatic ways. I've shared this example a couple of times already. I had a client that has done this. I have several clients that have done this, but one just very recently refied their house at 3.25% interest, 30-year fixed mortgage. They had an account where they had some monies in the account. They weren't happy with what the returns and what was going on with it. So they took that money and they put it into the personal bank policy. They're earning 6.1% dividends on that money. They're going to then access those funds through a bank line of credit that charges 3%. So their positive arbitrage on those dollars is 3.1. They're earning 3.1 on those dollars, and they're going to take those monies and pay their monthly mortgage. Now, I stated this earlier. Their interest rate on their mortgage is 3.25. The positive arbitrage they're earning on this money is 3.1. What's the net result, net effect of their mortgage interest now? 0.15%. It's the difference. Basically, we wiped out the interest on a 30-year fixed mortgage. Now, even at a 3.25% rate and the size of the mortgage that they had, the difference, they're still going to be paying out over $250,000 of interest if they had just paid their mortgage out as planned. This basically wipes that out by using this tool. This puts another $250,000 in their pocket versus the lender over the next 30 years. How many people would be effective positively with an extra $250,000 in their pocket? How many people's retirement would be better with an extra $250,000 in their pocket? This is a very simple example that I shared. I have folks doing much more than that and doing on the investment side and everything else. One of the things I state all the time is if you're making 7%, how would you like to make 10 on your money? But you can see how this makes a difference. And this is why I get so excited about it and I'm passionate about. It's not just getting a return on your money. It's having more money to spend in your lifetime. I haven't even talked about the tax implications, which happen to be tax-free. And we don't know what the future of tax rates are going to be and all that, so it eliminates that risk off the table. My point is you'll have more money in your pocket using this tool versus not. That's how it works. Because you're earning interest on money you spent, you're going to have more money. That's the end result. So if you want more information, contact us at yourpersonalbank.com. I'll be happy to discuss this with you, send you some additional information, and see how this can change your financial future.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may charge. Contact yourpersonalbank.com for current rates.